Hello, everybody. Welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. In my last video, I said that gold should be going higher after a consolidation period, and looks like we are still in consolidation. So we have actually broken the support line here, and we went lower. So we need to look at where we stand now. I was a bit concerned about the gold market in my last video. So let's see where we are now. Let's go over the data. The latest data point says that we will be stable. So probably this is an oversold territory and it will bounce back at some point. There's no data here. That's old data. We do see that this blue line is going down. The misery index is improving, so there's less unemployment rate, but we are seeing higher inflation. So these equal each other out. So I think that gold will still be strong based on higher inflation. Real output, we don't have news here. Supply and demand. I think that Chile had lower production and Peru had higher production. Gold demand. Yeah, we have seen large outflows from the GLD. So the stock level has been plunging. So the large investors are really selling gold from the GLD. So gold demand is really low right now. Not sure why. COMEX numbers are still stable. We have seen large deliveries in gold in the first quarter, so that should be good for demand. China deliveries were lower in February, but when we compare that to a year ago, then we are nicely higher here. Silver demand was very high, but I think it has come down a bit back to the 60 million level, 600 million level. So this spike has come back down. We had new data on central bank gold reserves. They were pretty stable, so nothing to report here. US mint sales have come down a bit, but we are still in an uptrend. Premiums are still above 50% on silver, so that's still very positive. I still expect gold and silver to go higher because of these high premiums. Shanghai premiums are still above zero. That's also good. APMEX gold premiums are very high on gold. Also very positive. And the PSLV premiums are still at zero. Now, this is very important. This is one of the most important data that we need to look at. Look at this. These are the commercial shorts, and the open interest is going down. When you see open interest come down and you see that the commercial shorts are covering, that means that we are bottoming out in gold. So this can probably go up a bit more. We get some numbers today on the COT report, and we will see how many shorts that they are covering. So this tells me that gold is bottoming out. And you can also see here on the long swaps positions, you can see that they're getting more long. So the net gold swaps are going higher. This is typically a sign that gold is bottoming out. So I expect gold to bounce. Maybe not this month because March is not such a good month seasonally. Look at this. Gold seasonality is not that good in March, but I think in April we will see gold go back up. Lease rates were pretty stable. The tips yield, this is most important. I need to talk about the bond yields in this video. You can see here that the tips have been crashing down, and this is also putting pressure on gold. So the trend is down. That's because bond yields have been going up. I think it has stabilized somewhat, and we are actually depending on the Federal Reserve to impose yield curve control. And then we should see this stabilize. And then gold could have a bounce back into this channel here. But yeah, everything depends on these bond yields. And I will talk about that later. Gold seasonality, March is typically a bad month. So if you want to buy, maybe buy somewhere in the beginning of April. This is still intact, consolidation, and then going higher. Okay, so let's talk a bit about oil, because this is a sector that we need to invest in right now. You can see here that the oil forecaster is forecasting higher oil prices. So how do I check this? I typically just open all these links here below like this. So those are EIA data. Then GDP is important, flight statistics and mobility statistics. So let's go over all of these data. First off, we have refinery net production. So you want to see this go up. So this is in a good trend. So this is only December, so we have January numbers to come. But this looks very positive that it's bottoming out. So more production from the refineries. Production of crude oil is going down. So this tells me that there is not a lot of oil production, which means that oil will probably go up in price. And we are seeing oil going higher. The ending stocks, you need to see this go down, because when the stock level is going down, that means that there is not enough oil. So that's when oil prices will go up. So this is a trend that's very bullish for oil. Then we look at the prices of heating oil going higher. Very good. Here also going higher. Also going higher. Here you can see that the distillate stock level is going down very fast to the bottom of this channel. And that means that there's a lot of demand for distillate, or could also be that there's not enough production of distillate. And when we look at this chart, you can easily see that it's a production issue. There's not a lot of production of distillate, probably due to the winter season in the USA. But on the other hand, we also have distillate demand going up. So this is going higher than last year. So that means that there is more demand. So these numbers tell me that oil is in a bull market. Then we look at the forecast here. You see that this trend is going higher. So demand and supply, so production and consumption, are both going higher. that means that the oil companies will have a very good business in the coming 2 years. So that's why I want to get into the energy sector. Then we have the crude oil rigs going higher, means that production is coming back. That's very good for the energy sector. Then we have the product supplied to the market, which is actually oil demand. And this is also moving up. So that's positive. Then we need to have a higher GDP. So GDP is at 10% right now. That's the forecast for Q1, quarter over quarter. And that means that, yeah, economy is growing, and that's good for oil. Flight tracking statistics. I always look at this because this tells me how many planes there will be in the air, and that's pure oil demand. And you can see that this is going higher. So more and more people are going to fly right now. And this is almost, yeah, this is just 100% right now. So the total number is now at 100%. So the demand has totally come back for flights. Not yet for the commercial flights, but it is going higher. So that's a good sign. Mobility trends, also important to look at. Are people actually driving? And you can see that it's moving up. So these are all signs that you need to be in the energy market. Okay, so let's look at some other data. Central bank balance sheets, it went down a little bit here, but ECB is increasing. China is also increasing its balance sheet, so that's all inflationary. Money supply, yeah, they actually changed something on the money supply. You can see here the big rise here. We didn't see this in the last video because they have actually changed the M1 money stock definition. So they added some savings deposits from M2 into M1, and that gave this spike up here. But overall, the trend is still up. And they also report it monthly now instead of weekly. So that gives us less data points, which is a shame, but yeah. We will do with the data that is given to us. Next is the deficit. We got new deficit numbers. You can see that goods and service deficit is still rising, still going down here. And here also the trend is still down. It has bottomed out a bit, so maybe the US economy is doing better. Otherwise the deficit would plunge, but it's now actually bottoming out. So I'm getting more bullish about the US economy. But the fact is that we are still in deficits. And this gap hasn't closed yet. So I think the deficit is going to probably stay at this level here. And that's not good for the dollar. Capacity utilization was up. So this is a sign that inflation will be coming back. Ten-year yield is also going up. As you can see here, that is a sign of higher inflation. Now, let's take a look at this leading indicator that I always watch to see where bond yields are going to go. And they are going to go much higher. Look at this. This tells me that bond yields will go much higher. So we need to prepare for that. Do not buy US government bonds. That's the worst investment you can make. Inflation is picking up here, as you can see. Not a lot, but we're in an uptrend. Personal consumption expenditures also up, which will add to inflation. We also know that OPEC wasn't going to increase the production, so probably oil will be going higher. And earlier this week, there was some news about Australia starting to buy bonds. So they upped their bond purchases from 2 billion to 4 billion Australian dollars. And well, this is pure yield curve control. So what you are going to see is the yields will be pushed downwards and the Australian dollar will fall. That's what we're seeing now. And probably this will also start to flow into the ECB and the Fed's monetary policy. Copper, we got some news on copper. So Goldman Sachs raised the copper price to 4.75 by the end of this year. So I'm very bullish on the copper and oil, also rhodium. These are commodities that we need to get into. And the best one for copper is Capstone Mining. So this is an update on that. You can also watch my other videos. Capstone Mining is currently at 1 billion and it should actually be already at 2 billion. So I expect this to double shortly. And if copper goes to 4.75 by the end of the year, this will be much higher. In this chart, I just wanted to show you that bond yields are correlated to the inflation numbers. So if you see these bond yields go up, that implies that the CPI is also going to go up. We will see inflation. India cuts gold import tax. This is a very good sign. That means that India will probably start buying more gold. So the tax has been going higher and suddenly we go back to 7. So from 12.5 we drop in half and that will be very supportive for the gold price. So this was from 24 February. We are still very early, but in the coming months, I would think that gold demand should go higher. This is a post about rhodium, which I'm also invested in Sibane Stillwater. And actually, this is a very important detail. So I listened to the conference call from the latest earnings, and the last 5 minutes of that conference call, which you can also just find here, the CEO responded like this. I'm going to read it. So Neil Froman said, "You ask some questions that would be confidential, that we may not be able to answer them. The rhodium supply decline is not going to come from us, but from other producers, and that would exacerbate demand. I would prefer we wouldn't answer your question about rhodium because it's market and relationship sensitive. I prefer we wouldn't answer it on this call. So he's getting really uncomfortable on this question about rhodium. And the most important thing about this is that Sabine-Stillwater is going to keep producing rhodium. So supply decline is not going to come from us, okay? That's important, but from other producers. So there will be a supply decline in rhodium, but from other producers. So that means that rhodium will go up, but Sabine-Stillwater will still be able to supply rhodium at the same production level. So this is a perfect play on the rhodium price. Perfect. So we're still in Sabine-Stillwater, and I expect this to go much higher. And then let's go to copper. We see that there will be a copper deficit, massive copper deficit this year and next year. Probably we will be in surplus in 2023, but then it's going to go into deficit again. So these are signs that copper will be at least stay at this level and go higher. So this is a good sector to be in. Bulk shipping rates are soaring. Let's see where we stand right now, because this will tell us if we are in a commodity bull market or not. Tankers are not in a bull market yet, but bulk tankers, you can see here, we have dropped a little bit, but we are back going higher. So this is a sign that the commodity bull market is intact. Rising yields. So everyone was afraid of rising yields. And I get that because today we are at 1.5% on the 10-year. So that's somewhere here. And dividends are at 1.5. So we are exactly at the dividend yield of stocks. So normally stocks should have a higher dividend yield than the bond yield because stocks are more risky. So less risky is the bond, and stocks are riskier, so they should give a higher dividend. So it's not normal that bond yields are at 1.5 right now. So that means that stocks will go down. But it's also important that you look at buybacks. Buybacks are also something that will keep the stock price higher. And if you calculate buybacks plus dividends, then we are actually at 3.8%. But probably in Q4, this number is going to drop. Because if you have higher corporate bond yields, you cannot do that many buybacks anymore. So this is going to go down a bit and will probably be at maybe 2%. So I think we are at the tipping point right now. Buybacks plus dividends will be at 2%, and bond yields are today at 1.58%. This is very dangerous, 1.6%. So 1.6% and buyback plus dividend at 2%. So if these come across each other, then we have a problem. We have a problem in the stock market. And that's what we are seeing now. All these SPAC companies, all these cannabis, all these EV companies that have no earnings, they are all crashing down back to where they came from. So that's what's the problem right now. So I expect that the ECB and the Federal Reserve should start yield curve control. And they will try to cap this bond yield here at this level. Somewhere 1.8, they should try to cap it and not let it go higher. Not sure when they will do it, but it needs to be done. Because otherwise we will have crashing stock market, and also we will get higher interest payments, and that will not be good for the US Treasury account. But I'm going to end with this post. I'm still very bullish on the stock market. You can see that Yardeni has upped his forecast from this here, and it was at 4,600, and he has increased it to 4,800. So you can see that we still have a lot of upside here in the stock market, and that's where I'm putting the money. Stay in banks, in energy stocks, in copper, rhodium. All of these things will go higher. And yeah, avoid the tech stocks. Avoid the tech stocks and get into value stocks. That's the conclusion here. Gold is consolidating, but I think it will start going higher again when the Federal Reserve is going to start yield curve control. So I hope you like this video, and I will see you next month.